All right, all right. Let's come in and take a look at the charts that we set up the other day. Um, Very first thing we're going to do is jump right into our class that we had last night. Last night we learned a little bit about selling options, right? So selling options is the process of collecting premium for the purpose of having income. Now that's what our yield max funds do, right? Yield max and Granite shares and Round Hill. These are the high yield companies that they trade options on our behalf, basically, is what they're doing. All right. So we give them our money, we invest in their funds, and then they take that money and go over into the underlying market and invest or trade options. Now, YieldMax does a different strategy than Granite shares. Round Hill does basically the same thing as YieldMax. So YieldMax and Round Hill do basically the same thing. And then you have Granite shares who does put options, whereas Round Hill and YieldMax do covered calls. Okay, so they're trading options on the underlying stock. We give them our money. So, like for example, Tesla. If we want to trade options on Tesla and we don't want to do it ourselves, we just give it to TSLY. And then YieldMax will trade those option strategies, covered calls over on Tesla for us, and then give us the money that they made with our using our money. That's how it works. So it's kind of fun. Options has always been a great tool for me. I've always loved them throughout my career, and I still love trading options, but it's fun to have somebody else trade them for you a little bit, take some of the pressure off. Not that I don't want to continue to trade options. I certainly do. I love trading options. But we're going to go through and we're going to review our call options that we put on the other day, and also uh, we're going to put on some put options today. So that's the idea, and then we're going to maybe do a little bit of a combination like we did last night. Last night we kind of talked about selling options to collect premium and how that works. And then that was at the class at the university. And today this is the lab for that. So we're going to go through and put on a little few more of them. We were only able to put on like one or two last night, right? Just a couple of examples, and we're going to go put those on again today, and we're going to find some places. Now, again, remember what we're doing today. These are not trade recommendations, okay? But remember that learning how to do technical analysis on your markets is very important, because really the name of the game here is who can guess the direction of the market best wins, right? That's really what it is. Those who are able to guess the direction of the market get to make the most money. And once you get good at predicting market direction, well, that's how you make more money. And so if you don't know how to predict the market direction, then you can use some of these other strategies using options where we call them neutral option strategies, right? Where we can significantly put the odds in our favor and not really have to pick the direction of the market. Hold on a second. I'm going to drink a little tea here. Try and warm my throat up. So you can use neutral option strategies too, so that you make money no matter which direction the market goes. Of course, that's less of a risk, so you make less money. And some of them, the market has to move quite significantly to get the market to make you any money in the first place. And that's a little bit of a problem with that. So really the way you make money when you trade options, the best way to make money is to try and predict the market's direction. Now you can give yourself a little buffer. You can say, well, I think it's going to be above this certain price level by this certain date. And that's really kind of the game you're playing, right? We're going to go do some of those so you can understand a little bit more about them. But mostly what I'm trying to do today is just to try and example what it's like to collect premium. All right, sell options to collect premium. And usually when we sell options, it's not just a naked option. We're not just doing a sell all by itself. We generally sell options for the purpose of collecting premium so that we can pay for another call option or a put option that we want to buy. Okay, so it's kind of a combination tool. Not that you can't sell naked. Naked means that you don't have a protective option on the other side. All right. It's just, we call it a naked option. So that means you'd have to have full margin amount to cover it. And that's okay. There's places where that's appropriate and we can do that. But for the most part, we're going to use it in a combination. Now, call options, on the other hand, a lot of people just buy call options because if you buy a call option, right, the market goes up. So buying options is different than selling options. So when you sell an option, you generally do it in combination with another tool, with another option. But when you're buying options, you can do those by yourself all the time. The combination of options is a nice thing to do because you can reduce your cost, and reduces your break-even point, right? And that's the big name of the game, is the break-even point. So this is an option that we put on the other day, right? And then this one, when we were learning about call options, and we were looking at this market, and we're saying, hey, this is Microsoft. It came down and made a nice little drive down off this top. And we were saying, well, what if it goes back up from here? What if it turns and starts to go back up? We could buy a call option. Well, it's not doing that. It's turning and going down. All right. So we can see that right here, we're losing on this particular trade. Now, the max amount of money that we can lose is the premium that we paid for it. Now, remember, everything we're doing here, these are not trade recommendations. All right. I've tried to make that clear. These are not trade recommendations. These are all we've got available to us today, right now. And just because we got class starts at 8 o'clock today, and on class starts on December 4th, doesn't mean that that's the right day to be buying and selling these options. I have to do it today because that's today's class. Just because we go in and we try and make some logic of the markets in some sort of justification for putting our option on, doesn't mean that these are trade recommendations. All right. These are not trade recommendations. It just happens to be that today happens to be the day we got class. And so we're going to put options on. Doesn't mean today is the best day to be putting options on. All right. So take that with a grain of salt. These are not trade recommendations. These are just examples of how options work. And we learn even when we lose money. Okay. So this is a learning environment. Everything we're doing here is in demo money. I'm not trading real money here. I'd show you my other accounts where I'm trading real money. This is just a learning environment, just learning how to put options on. Okay. And we'll make some justification for whatever the market's doing. And we'll say, oh, yeah, maybe today we think the market's going up, we'll buy a call. Or we think the market's going down today, we'll buy a put. But it's not a trade recommendation. So don't get crazy on me and go out and start buying these up. Some of you guys I know did that. You mentioned in class last night, hey, you did that, and I made money on it. I'm glad you made money on it. Just remember that oftentimes what we do here in these classes is not the optimal time to be putting these positions on. We have to do it, all right, because it's class. All right, so this one here, we put it on a call option because we were saying, well, there's the possibility this market could go up right here. And it didn't. It went down. It's going down. It's continuing its little ABC down slide. So we were learning how to put on calls back when we put this one on. And this one looks like, from a technical analysis standpoint, this is our one little drive. It broke the blue lights. And looks like it's going to continue to come down. Well, how far do we think it was going to come down? Well, nobody knows, right? But we're going to do a little scientific wild-ass guess here. And we're going to put a Fibonacci ruler on here from top to bottom. And the Fibonacci ruler says that this market's coming down into the Fibonacci sweet spot somewhere down in here. So our projections say down into this region here. And maybe if it does come down into this region here, this is where we could come in. We could be a buyer down in this region here. But right now, if it does come down, we could buy a put, right? A put option would make money on the way down. So we could buy a put in here. Now, there's another strategy that we can do, which is called a cash secured put. Okay, a cash secured put. Now let's go do one of those. Okay, now again, guys, just because I'm doing it doesn't mean it's a trade recommendation. We're just learning how. So we're going to come in here and we're going to say a cash secured put would give us the right, but not the obligation to buy the underlying stock. Oh, just deleted the wrong tool. I wanted to keep that one in there. And you can see why I have the Donchian channel in there. Donchian channel is almost the same thing as the way I've got it set up is almost the same thing as drawing that Fibonacci ruler. So it tells me where that center line is. That way I don't have to continually be drawing Fibonacci rulers. It's just a lazy man's Fibonacci ruler. I'll show you the settings. I go Donchian channel. It's an overlay. Right click, come in here, add overlay right here, Donchian channel. That's how I do it. And then over here, I put this to a period of 100. The only reason I do that is because I want to see the top at the bottom of the last 100, and then the green line right in there. That's kind of shows me. Let's make that a little brighter. It shows me where the center of that is. Okay, of the last 100 bars. So it's kind of like drawing a Fibonacci ruler. But this market, we're going from a much larger direction than just 100 bars back. So it's kind of just pointing to us from this level here. For me, it's just a guide. Okay, it's not anything really super important, but it's just kind of a guide. We can turn it off right now just to clean the screen up a little. All right, so these are moving averages right here, and I'm going to simplify this one too. We're going to get rid of the 100. We're just going to use 200. All right. All right, so save. We'll save that, and we'll make it simple for us. We'll not have to look at all these indicators. All right, so here's our 200 period moving average. So if we think the market's going to stay above this region in here, we could come in here and we could sell, right? Sell a put option, and we're going to sell a put option down here. And why would we do that? If we come in here and we're going to go out, maybe, how long do we think it's going to take? Well, if this market comes down the same volatility scale from A to B, all right, how long did it take to do that? We can come in here with our little calculator and we can see, well, October 28th, oh, grab the wrong tool again, land. Okay, from October 28th to November 25th, that was 27 actual days, 20 trading days. So 27 days. So if we say, well, if it takes another 27 days, so we put this one here, and we go out 27 days, we can make a wild ass guess that the market might be down here at this point in time from where it was. If it does that same thing down in here, 28 days right in here. So there's 28 days. That'd be December 22nd. So sometime around towards the end of December, we expect this market to be down in this region here, right? If it just continues doing the same thing it did before, which is this little run here, and we're just going to project that that market's going to do it again down here. That would bring us down into this region here, and it would do it by the end of the month. Okay, so now we have our time involved. So whenever you do an options, right, you have to have amount of time. So time is important. So that's how we do a Fibonacci calculation on time. So we're doing a price and time calculation. That's what Fibonacci does. It's just a ruler, all right? It's just a ruler that helps us project out into the future based on the past. Past performance is not necessarily indicative of future results, but it's the best we got. So that's why we use it. All right, so that helps us identify where we think that market might come to if it's going to continue to slide down and how long it's going to take it to get there. So now we can come out and we can say, well, I need at least 30 days. There's 43 days, but I like to buy at least a little extra time so that I don't have so much time decay. Remember the time decay we talked about? Markets die over 43 days. It's just going to start chopping away. But if we're going to sell premium and collect, well, that chopping away at the premium is good for us. That's how we make our money. So we're going to go out. Let's go out 78 days. I only need 30. 43 is not enough. Let's do 78 because I want to do the ones that are in bold here. See the ones that are in bold? Those are the quarterly expirations, and they have more volume. More people trade those than they trade these little light weekly expirations. So we're going to come in here to 78. Click on that one. Now we selected 78. We come down to the options chain. You can see down here it automatically sets that for you at 78 here. These two talk to each other. So if you set it up here, it changes down here. If you set it down here, it changes up there. Okay. So now we have on here, you can see that we have our call option, which is this one here. And you can see we got quantity 1. Premium is worth 2,100. We paid 2,700. So we're losing money. That's why we're losing money, because it's going down. All right. So this is the at the money option right here, $25.95. So what we're going to do is we're going to come in here and we're going to sell a put option down here. Now, put options are purple or a different color. So we're going to come here. They're the pink ones. And we're going to come in here and I want it to be right down in this price level here. So I don't know what that price level is here. So I can just come over and drag and drop it right here. So I'm going to sell a put right down here. And we're going to put it right here at the 61.8% level on the Fibonacci scale. All right. So right there, and it says that we're going to receive $652 for doing that. $652 for placing that order. Let's get rid of that right now. I want to keep that. Let's put that back. All right, I keep deleting my Fibonacci ruler. Let's keep that. All right, we've got our little double top up there. So why would I sell a put option right there? Well, the put option is going to give me $652. And remember, the name of the game of a put option, when you sell it down here, this is called a cash secured put. And it's cash secured because you got to have enough money in your account to pay for the margin amount that you're going to require, because you're required to be on margin when you sell options. So the margin amount that's going to be required to buy the underlying shares. And in that case, you can see over here, it's got a little calculator. You can see right there, it says margin required is $7,281. So you're going to be required to have $7,281 in your account to put that on. But what that's going to do is it's going to give you $655. Now, the carnival game. So this is the carnival game. So the carnival game now comes in and says, Land just made a decision that says this snaky thing here that goes red and green, the price bars, right? This snaky thing, as long as the snaky thing hits the purple line above the red line, Land gets to keep his $655. That's what that means. So I'm losing money on this one, but I'm making money on this one, okay? So as the market comes down, this will actually show that it's losing money, but you're not losing money on this one because that's only if you bail out. Remember we talked last night about if you don't fulfill your agreement, you bail out early. Well, if you bail out early, you can lose money, but if you don't bail out early, you got to keep the money. All right. Now, if you bail out early, you might lose money, but you keep some of it, but it's not enough to cover what you lost. So the name of the game is to put this down here far enough that the market is going to hit that purple line, right? It's going to hit that purple line above the red line. So the red line, this is the carnival game. I think the snaky thing is going to stay above the red line and hit the purple line first. If you're wrong and it comes down underneath and that market doesn't hit the purple line above the red line, well, you're going to get assigned 100 shares of stock at the red line. So wherever the red line is, wherever the snaky thing hits the purple line is where you're going to have to take the shares. Actually, you take the shares at the red line, but this is where the difference between where you're going to make money and lose money on your shares. So your shares, if it comes clear down here and hits the purple line that far underneath the red line, well, that's how much money you'd lose on your shares because they're going to assign you the shares at the red line. That's what selling a put means. Now, if you want to buy Microsoft at that price, this is what this is generally used for. Remember, we come in here and let's clear all this out. And remember when we have limit orders, let's just come in here with the normal limit order. We're going to come in and put a limit order down here. All right. And we're going to say, well, if Microsoft comes down to this level, and we'll do our Fibonacci's again, pretend like we know what we're doing. We're going to come in here and draw a Fibonacci ruler in here. And we're going to say, well, the market we think is going to come down to 61.8. So we're going to put a limit order to buy our shares at 61.8. All right, that's how you would buy low, right, in an attempt to sell high. So you're going to buy your shares down there. Well, from now on, if you're going to buy shares down underneath the market with a limit order, don't do that anymore. Why? Because you can do the exact same thing with an option and they'll give you a bunch of money to do it. All right, because you're contracting with them. You're saying, hey, I'm going to buy 100 shares here. And hey, if you're going to buy 100 shares, you might as well make money doing it. So that's what a limit order does, right? Limit order comes down. The order, because it's buying below the market. So the market would have to come down, hit the limit order, and turn around and go back up to make money, right? But you're like, oh, I'm happy with that because Microsoft's a great company, and if I could buy 100 shares down here, I'd be really happy. So you might want to do that. But there's a better way. You might as well come in here. If you're going to buy 100 shares of stock anyway, don't use a limit order. Put an option in here. Come back over to the options tab, and you're going to sell a put option. Because if you sell a put option, it's going to do the exact same thing as buying with a limit order. Because what's going to happen is you're going to get assigned 100 shares of stock at that price. But they're going to give you, in this case, $732 to do that, to put that limit order on there to buy those shares. Well, we might as well get the $700, right? If you're going to buy the shares anyway. Now, the game here is you might not get your shares. Why? Because it might not come down and close and hit the purple line underneath the red line. It's got to hit the purple line underneath the red line for you to get your 100 shares. But if you wanted 100 shares, you might be disappointed because it might come down here and then turn around and go back up and you wouldn't get your 100 shares. Then you'd be like, if you're using a limit order and you wanted 100 shares, you'd be mad, right? I didn't get my 100 shares. Now I'm not making any money. Well, they're going to give you, if you do it with an option instead, you're going to get a consolation prize. The consolation prize is $732. Not such a bad consolation prize after all, is it? That's not such a bad consolation prize just for not getting your shares. Again, that's called a cash secured put. All right, it's very popular, very common, and it's what Granite Shares does to make their money. So many of you in this class like to trade the Granite Shares funds. So anytime you do trading Granite Shares, again, you give them your money, and then they will take your money and come over and buy cash secured puts with it. And they use your cash to secure it. Actually, my understanding from what they reveal to us about their secret strategy is that they oftentimes will come in here and they'll buy a put down here too. So they'll buy a put down here. So it's not cash secured. It's partially cash secured. It's covered. It's called a covered put, or this is just called a in this case, it's called a credit spread. All right. So what they're doing is they're doing a credit spread where they're selling the option here, collecting $700. They're buying insurance just in case the market goes down farther. They don't want to have to cover it with cash. So they put in some insurance policies, but they have to pay $342 for that insurance policy. And by paying $342, they have to pay that with the $732. So really, they're only making $390, not the $732, if they cash secured it, because they're securing it with an option. All right. So as we oftentimes say that when we're trading these Yield Max and Granite Shares funds, we're in the insurance business, because what they do is they sell the insurance and collect the premium. So that's what he's doing here. He's selling his insurance premium, right, against the market falling. He's going to collect $730 and then hope that he doesn't have to take the shares, because he doesn't really want the shares when you're trading the options like this. And then this $345 is the insurance that he's buying from somebody else, maybe possibly Yield Max, right? Yield Max actually doesn't do put options. They do, because they do synthetic longs. So that maybe he's buying it from Yield Max. Who knows, right? It's all done in an auction. So he's got to pay $345 in insurance to protect him in case the Microsoft stock actually goes way down here. And he doesn't want to have to pay the loss between that green line and where the stock's at down there, which would be $7,000 in this case. All right. So that's how it works. I know. I was going to go, this is really hard. No, it's not. It's not hard. Just stick with me and we'll do more of these and it'll make a little bit more sense. Okay, so let's come in. Let's clear all this out again. We'll delete all this off of here. We'll put our Fibonacci ruler in there. And we're just going to do a simple cash secured put. Very simple, easy cash secured put. Right straight out of the gate, we're just going to come in here. We're going to sell a put option down here by 61.8. They're going to give us $727. If the market comes down here and hits the purple line under the red line, we'll be assigned 100 shares. And we'll be fine with that too, because if we have 100 shares, the market will probably go up from there and we'll make money on our shares. And then we could liquidate our shares if that's what we want to do. But right now, we're going to put this in here and they're going to give us $727. So we're just going to come in here. I see if they market order into it. And sure enough, there we go. We got our position. They just gave us $720. No big deal, right? Easy cheesy. Let's go do another one. Let's go somewhere else. Let's go to NVIDIA. Ooh, NVIDIA. Let's get rid of all of our drawings. We'll start over from fresh. All the drawings. Delete all drawings land. Okay, so we're going to, what did I just do? I said show drawings. Show drawing tools. Show tool button lock, show drawing tools. Okay, delete. Okay, I think we're good. Okay, so now what we're doing is this is the 200 period moving average. And we're going to say, well, you know what? This is NVIDIA. And it's a really strong company. And it's got a nice little trend line in here. And I think it's going to stay above the 200 period moving average. All right, so whatever your logic is, we're going to run a Fibonacci ruler across here. And you can decide what your logic is on this. But we're going to do another cash secured put. Okay. Very easy, very simple. We're going to come down here and we're just going to go out. And maybe we don't want to go out 78 days this time. We'll go out 43 days. You could do, you know, one of the very common things is because, you know, we like to get paid every month. If you're in Yield Max now, you want to get paid every week. So maybe you could do these every week, right? So they've got some that are expiring all the time. They're constantly expiring their options so they can send you money every week. But we're going to do, you can do any number of these. So just want to do the dark ones, 15, 43. Let's try a 15-day. Now, the problem is if you do a 15-day, you have to be closer to the market. You have to take a bigger risk, all right, to make it worthwhile. So we're going to come over here. And again, we're going to go down with 15 days right here. We'll pick 15 days. And we're going to sell a put. Again, we're going to sell it down here, meaning that we're just going to buy our option or buy the shares, 100 shares, if it touches our the purple line below our red line. So as we do that, we notice that right here on when we've only got 15 days, look how much money we're going to get. It tells you right here how much money you're going to get. Of course, it tells you down here too, but it tells you how much you're going to get. You're going to receive $19. Well, that's not a lot of money to wait. Well, you only have to wait 15 days and it's a 0.92% return. That's not very good. Here's where you get that right there. See that? A 0.92% return. Now that's 0.92% return on your margin. because they're going to margin you at 2,180. And so this is 0.92. It's not very much money, but it is in 15 days. So if we go up and we just go up one, let's see if we can get up to 1%. There's 1% return. 1% is not a lot. You say, well, it's only 1%, but it's 1% in 15 days. How many 15 days are there in a year? There are, so let's say that this is 2 weeks and we got 52 weeks in a year. So it's 52. We're gonna just say that we've got 24, right? We got 24 2 weeks in the year. 52 weeks. We got cut it in half, but we got 12 months. We're gonna double that. We got 2 per month, so we're gonna go 24. But it's 24 times 1. So it's 24 times 1. I don't have to use a calculator for that. It's 24% annualized return. That's a lot of money. Now, $23, you're going to get chewed up in spread. Well, it says you're going to have to pay let's see, we're going to have to go up to 23. Yeah, we're going to have to pay a $1 spread. So we're not going to get the full 22.50. Plus, we're going to have to pay a $1 spread to get out. Now, there's no commissions when you trade options in track and trade. Many other companies charge you commissions, but if you're trading options in track and trade, there's no commissions on options. All right, so you can pay the $1 spread, so you're not going to get the full $22. You're only going to get $21, and then you're going to have to pay the dollar on the way out probably too, but maybe not, because it might just go to the end and you don't have to pay. So there you go. You're going to make $22. Are you happy with that? I mean, it's 24% annualized return. That's a lot of money. You can't get that at Cash Valley Bank. But what are the odds that you're going to get paid off? Now, if you come over here and look on the little table, it tells you the odds down here. Now, we're going to slide down and find that. Now, this is a put option. It's way down here. The odds of this paying off and giving you your $22, probability of being in the money is 97%. You got a 97% chance that this thing's going to give you your $22. So if you went down to, now I know we don't like to compare trading with Vegas, but a lot of people understand Vegas. So if you went down to Vegas and you had a 97% chance of winning every time you played the Vegas table, would you be happy with those odds? If they spun the wheel and every single time you had 97.2% chance of making money, would you go play that table? All day long, right? All day long. But yet you look at it here in the stock market and you're getting the same thing and you're like, not enough. I ain't gonna do it. I ain't happy with 24% annualized return. I ain't doing it. Okay, well, let's make it more then. Okay, let's give you some more. So we're going to slide this up a couple more. Let's go up so it gives us 2%. See if we can get it up to 2%. There we go. There's a return on risk of 2%. Now you're getting 48% annualized return. They're going to give you $149, right? You can see it right there. Is that, no, that's not $149. That's the that's the Fibonacci calculator. Let's see if we can get that, move that. Okay, they're going to give you $50. Okay, so 15 days. In 15 days, they're going to give you $50. And all the market has to do is it has to stay above, it has to hit the purple line above the red line. This snaky thing has to stay hit the purple line above the red line. That's the carnival game that you're playing. All right. So that would give you a 48% annualized return. I ain't doing it. Not worth it. Not enough money. $48 in 2 weeks ain't enough. I want more. Okay, let's push it up a little higher. Let's push it all the way up to the 38.2, just underneath 38.2 on that Fibonacci scale. We'll go just a little under it. There's $114 in 2 weeks they're going to give you. But because it's getting closer, you better be good at picking market direction, because if the market comes underneath there, they're going to assign you 100 shares and you're going to have to come up with, enough money to buy 100 shares was $15,000. Of course, you're going to be on margin, so it's going to be about half of that. All right. So do you want to do it? $113 in 15 days. $113 in 15 days. How much is that? We're at 4.5% times 24. So we got, again, let's do this math. 4%. So we're getting 4%. And we got, how many? We said 24 times 4% equals, that's a 96% annualized return. 96% annualized return. Now, can you see how come Yield Max and Granite shares can return to you these eye-popping dividends? It's because this is how they're doing it. All right. This is how they're doing it. So this right here, $113 in 15 days, gives you equals to be about a 96% annualized return. That's a lot of money. That's a lot of money. $115. Ain't enough for me though, man. I ain't doing it. What are your odds that the market's going to stay above that red line? It tells you right here. What are your odds? 87% chance that the market's going to stay above that red line. That's pretty crazy. Probability of being out of the money is 87%. That's still pretty good. 87% chance. You go down to Vegas and spin that wheel and you win 87% of the time. That's what that's telling you. You're going to get to keep your $114. And the only bad thing about that, the only downside to this, to doing this strategy, just doing the cash secured, not even doing a secured, not putting another option in there for premium protection, is that you just get assigned the shares at that price. And who wouldn't want some NVIDIA shares at that price? Oh, I'd love to have 100 NVIDIA shares at that price, but man, I can't afford 100 NVIDIA shares at that price. Okay, well, then you're going to have to bail out. And if the market falls below your red line, you're going to have to liquidate and take a loss because you can't afford to put this on, right? You got to have $2,819 in your account, the margin requirement to cover it. But you're going to have, when you execute, if you get filled, you're going to have enough to buy the underlying shares, right? And if you got maybe a margin amount, well, they're going to margin you at the amount you're going to need, $2,819. So that would be your max loss. They're going to margin you at max loss, $2,819. But there you go, $113 in 15 days. Not enough, Lan. I want more. I want more. 96% annualized return is not enough for a guy like me. Okay, well, let's give you some more then. Let's push this a little closer. I think that market's going to go straight up from here. There ain't no reason it's going to come down. Okay, well, let's bring it up here. Let's put it right up here underneath that little trend line we bought. That's $335 in 15 days. That's an 8% annualized, 8% return in 2 weeks. 8 times 24, 8 times 24. That's 192% annualized return. 192% annualized return. What's my odds on that? My odds? You got an odds of 69% chance that you're not going to have to take delivery on the options. That's what that tells you, 69%. Okay. Get a 30% chance you're going to have the shares. Okay. But you're going to get $337 either way. You get your $337 even if you have to take the shares. That's cool. That's cool. You mean if I buy the shares right here, if I get assigned the shares, because the little snaky thing hits the purple line underneath the red line, I have to take 100 shares? Yep. But you still get $335? Yep. Oh, it's not so bad. That's kind of cool. I get my $335 and I get the shares. That's exactly right. All right. That's still not enough for me, Lan. I want to put it right there at the money, right where it's at. It's going to go straight up from right there where it's at. I want it right there. Okay, you got 15 days for the market to close above that red line, and it's right where the market's currently trading, but they're going to give you $562 to do that. What? $562 just for putting that order on? Yep. Just for putting the order on. Now you might get some shares and they might be down a little bit lower, might be down there underneath if they hit the purple line. Wherever the market hits the purple line underneath that red line is where you're going to get you're going to have to take your shares at that. You're going to get your shares at the red line price. but they're going to assign them to you, and the market's going to be down here, and you're going to take the loss between there of 100 shares. All right. But they're going to give you $500. Where's $500? So, you got a little buffer in there. So just right there would be your break-even point. They're going to give you $500. If the shares go down and hit the purple line underneath this, it's only a loss from underneath the yellow line, not the red line, because they're going to give you the little buffer of $560. Ooh, that's not such a bad deal. That's pretty cool. If you get pretty good at deciding where markets are at, or if you're willing to take less than 11 times 24, which would be a 264% annualized return. If you did that every 2 weeks, you just do one of those every 2 weeks, you'd get a 264% annualized return. I think I could probably make a living off that. Do 2 or 3 of those, do one here, do one on Microsoft, do one on Amazon, do one over on, see what I'm saying? Now, you don't have to do it right at the money, because you're like, well, I'm really good at guessing market direction. I know it's going to go up from here. Okay, well, if you have that kind of confidence in your ability to determine market direction, you can make more money. Again, the name of the game is to be good at picking market direction. Picking market direction makes you more money. I'm good at picking market direction. Therefore, I'm going to make more money than the guy who's bad at picking market direction. So that's why it's good for you to become very proficient at technical analysis and determining market direction. Now, a lot of guys will say, well, I am good at fundamentals. I just watch the news, right? I'm a news fundamental hound. Well, that's okay too, because you need to have a catalyst to drive the trend of the market, right? So as long as you have a catalyst to help you make the determination that the market's going to go up or down, then that's going to help you. The problem is that for us as little tiny small speculators, most of the time, by the time we get the news, by the time we hear it, it's not worth knowing. Anything that everybody knows isn't worth knowing, because it's already known. It's already built into the price. In fact, most of the moves that you hear on the news have already been taken advantage of the people who make the news. So by the time you hear it, it's already done. It's over with. You notice most of the time the news only tells you what happened already. They never tell you what's going to happen, because they don't. Their job is not to tell you what's going to happen in the stock market. Their job is to sell you new cars and soap, right? You go watch the news. What happens every 10 seconds, every 5 minutes that they're telling you about the stock markets? They stop and sell you a new car and some soap. And then they come back and start telling you about the stock market. Don't go away, because right after this message, I'm going to tell you the most important thing you ever saw about the stock market. So stay tuned. And then they go sell you a used car, or a new car, because on TV they sell you new car and some soap. And then when they come back, oh, the neatest thing you ever needed to know about the market is yesterday the market broke higher because of this event. Maybe the event had nothing to do with why the market went higher or not. Doesn't matter to the news team, because they're just going to take event 1 and attach it to event 2 and put them together and say, well, that's the reason why it went up. They don't know. They're just there to entertain you, try to get you to buy a new car and some soap. So by the time you hit the news, or those guys put some A and B together, it really, we oftentimes say that correlation is not causation. Correlation is not causation. So this is why fundamental analysis, just listening to the news, unless it's news that you can get that comes out to the same for every single person, doesn't work. Trading the news is pretty much worthless. You need to have a technical analysis, mathematical model that you can trade with, which tells you what your probabilities are of a market rising or falling in price technically, because you need a setup and a trigger and a point that's going to say, well, the market's going to switch directions here. Is it going to switch directions there? Well, we don't know for sure, but it's a setup and it's a trigger that's worked in the past. Past performance not necessarily indicative of future results, but it's the best we got. So we look for these recurring price patterns. We look for these mathematical models. We look for these signals, and they help us determine when the markets are going to rise or fall in price, because we can't trust the news to tell us the truth, because the news does things like this. The news comes in and they'll say, well, we get more murders in Chicago in the summertime, And we also sell a lot of ice cream in the summertime in Chicago. Therefore, ice cream causes murders. Correlation doesn't mean causation. Just because we sell a lot more ice cream in the summertime in Chicago and there's a lot of murders in the summertime in Chicago doesn't mean that ice cream causes murders. But they're correlated. Both go up in the summertime. See, that's what the news stations do. They take things that are not correlated and they assign them to them. And you think that they're so smart. Oh, they know why the market went up or why the market went down. No, they don't. They have no idea. They're just selling you cars and soap. All right. And you're sitting there trying to believe that they know what the market's doing. They don't know what the market's doing. They just go back and they say, oh, Donald Trump said this and the market went up. Therefore, Donald Trump caused the market to go up. Bullshit. I call bullshit. All right. Same thing. Oh, the market went tumbling, tumbling, tumbling down. And Donald Trump said this. Therefore, Donald Trump caused the market to fall. Bullshit. I call bullshit. All right. That's how the news does their news. Correlation doesn't mean causation. Now, sometimes it does. I mean, sometimes you can, it's going to be obvious that a news event caused something to occur. But most of the time, I would say almost every single time they're doing false, they're giving you a false dichotomy. All right. They're just selling you cars and new cars and soap, and that's all they're trying to do. But and then they do this correlation crap. Okay, you can do way better yourself by just learning a few indicators, a few recurring price patterns, and a couple of models that the market has a tendency to follow, and you can do way better yourself. You don't need the news. All right. Because most of the numbers, most of the things that the news talks about is already built into the chart, because the people who make the news already moved the market. So news is, if you're interested in buying soap and new cars, go watch it. All right, so that's what we're doing here. So this is an at the money option. All right, now if the market goes straight up from here, which I'm not saying it is, this is not a trade recommendation, but we are getting to a point where this little blue line here, which is a mathematical model, is coming down. And generally speaking, when the market gets close to that little blue line, it starts to go back up. See, it does it here. Look, past performance, not necessarily indicative of future results, but it's the best we got. Every time that little blue line comes in contact with the little snaky thing, it has a tendency to go past it, right? Here's another example right there. Little blue line comes in, and well, the market has a tendency to go up. Not always. Look, here's one where the little blue line came in and it didn't go up, it went down. So does it work every time? Nope. Doesn't work every time. Look, there's one dot right there. One little dot where it broke. See that? So the market came up, the little blue dot intercepted, and it went one time, and then up it went again. So this is called a drive. We call these drives. Drive 1, drive 2, and then kind of ugly little drive 3. It's kind of a sideways and then a drive 3. And then it almost went to a drive 4 over here. So this was just a crazy market. All right, up here on top. So it's really strong. It doesn't like to come back down to the Fibonacci sweet spot. All right, it likes to stay up there. People like this market, and so they don't let it flush down as far to make it go back up. So it's staying up here. So this gives me pause when we get this little movement here like this. We may just get another one at this intercept of this little blue light. So you might anticipate, well, I think the market's going to go up, so I'm willing to take a risk. Well, how big of a risk? Well, I don't know. Not a very big risk. I'm not very good at this, so I'm going to put it way down here. Well, I'm only going to make $17.50, or then we put it up just a touch just to give us an even number. So I'm only going to make 1% annualized return. I'm only going to make 24% annualized return. Okay, 24% annualized return is nothing to sneeze at. But you've got a bigger buffer in here. All right. The likelihood of the market hitting the purple line is pretty high above the red line. But if you're good at predicting this and you're like, well, I really think the market's going to go up because the guys who sell soap and cars said it is. All right, well, then put that right there next to it and right next to it, and you're going to get $530, and all that market has to do is just go up. Yeah, but Lane, why don't I just buy a call? Well, do that. I got an idea. Let's just buy a call instead of sell a put. All right, so we're going to come in here. Let's get rid of all the drawings, and we're going to buy a call instead, and we're going to do the math and see the difference between selling a put to get $530 versus buying a call. So let's come in here and buy a call. We're going to delete this one, and we're going to buy a call instead. We'll just drop it right at the exact same price in the exact same time frame. All right. So we're going to put this right in here. We're going to put it right at the exact same price, right at the money. So this is an at the money call option. We'll come over here to the call options. Oh, right at the money's right here. $640 is what you're going to pay for it. So you're going to pay $640. You're not going to get $640. So now the market has to go up. But you got unlimited profit potential. So the market has to go up, though. If it goes down, even just a little bit, you lose money, right? And you can lose the whole thing. What if it goes down and touches the purple line underneath the green line? Well, you lose all $640. But what if it goes all the way down here? Well, then you still lose $640 because the max amount of money you can lose is $640, $650. That's it. That's all you can lose. Okay. But what if it goes up, Lan? Well, it has to go up at least $652 to give the guy who sold it to you his money. So it has to go up $652 up here. $652 is right about there. It's about the best close I can get. So that's $652. So now the market has to go up and hit the purple line to make money with your call option. It has to be above that line right there. That's your break even. So if you buy a call option, the market has to go up there just to pay the $650 to the guy that sold it to you, right? If we were sellers before, now we're buyers. So now the market has to go up there to pay the guy that we sold it to, and then anything above that is profit. So if I have this and it comes up here in 2 weeks, let's say it goes from here all the way up here and tests this previous high. Well, we'd make $3,205 minus the $651. That would be our total profit. Now, if you're good at this and you know that that market's going to hit those blue lights and take off like a rocket ship, you might want to buy a call instead of sell a put. All right. But what if it doesn't? What if it just wanders sideways? Well, if it just wanders sideways a little bit, you're still going to lose money. You might not lose all $650. What if it just hits right halfway? Well, you'll make $300. But reality, it's not going to be a $300 profit. It's going to be a $300 loss, right? Because you're going to pay $662 and you're going to make $300. Well, I didn't make any money. You did. You made $300. Well, I paid $600. Yeah, but you made $300. Lan, if I make $300 and I paid $600, that's not a profit. Oh, that's called buying calls. That's how calls work. But isn't it the same with puts? No. The market just has to stay above your line with a put and you get the full premium. You mean I don't have to pay? No, because you're collecting the premium. But the maximum profit you can make is the premium that you made. You can't make more than just the premium that you received when you sell an option. Oh, light bulbs are coming on here. Light bulbs are flipping on, flipping on, flipping on. People are making connections and synapses are touching each other. Oh, we're making ideas here, coming up with ideas. Oh, I see how it works now, right? Let's go do another one. Let's put this one on. What is that one? That's a call option. How would you put that on? We're just going to come over here and hit market order. You probably don't want to hit a market order. You can, when you're doing it in the real money market, you might want to bid for it to try and get that extra dollar or two. It's just kind of fun, but the market might move. I used to do this with my buddy, Doc Brown. We'd trade together and he would tell me that he wanted to get into the market. He'd have me do all the stuff, right? He'd say, okay, I want to get in right here. Go put it in. And I'd sit there and do the little bid and ask stuff. And I'd try to save him, $6 or $8. He'd get so mad at me. He'd just like, get in there. By the time you sit there and dink around with the little bid ass spread, the market's moved $6 or $8 anyway. So just do the market order. Just get in there. I want it on there right now. So he didn't like to play the bid ass spread. I think it's fun. Okay, let's go look at a different one. Let's do a different scenario. Now let's come in here and do something a little bit different here. Let's go to Google. Well, we got one on Google already. This is our put option on Google. Now we're losing $50, but not really because we sold this, right? Oh, no, we didn't. We bought it. We bought a put. Okay, so we paid $1,285. The market hasn't fallen yet. The little blue light hasn't intercepted, right? So that's what we want to see. We want to see that little blue light intercept. So we might have a little bit of time left in here. I don't know. But it kind of curls and comes back, and that's where it intercepts the blue light, and then that's where it flushes. So here's another blue light. But it's been going up every time it intercepts the blue light. It's a little tiny fall, and then it goes up again. But is it going to do that again? I don't know. Nobody knows. But look how many times it's gone up. We've gone through the accumulation distribution right here. So we talk about the Wyckoff theory. This is a 200 period moving average. We'll just take that right there as this is the accumulation zone right in here. All right. And we're going to call this our first break. So that's our drive 1. Got a counter trend. We got drive 2, counter trend, drive 3. Holy cow, counter trend, drive 4. We're in the 4th drive. That's like a unicorn. We rarely get 4 drives. Doesn't mean it can't. We can get 5, 6, 7, 8, 9, 10. Certainly can. It's just really rare. The odds of that happening, of getting a 4th drive like that, are just really rare before we get a pullback. Now, we're just anticipating a little bit of a pullback. And we're going to go into the Fibonacci ruler, and we're just going to go off this first drive, and we're going to go all the way to the very top. And again, where would we expect it to come? Back down into the Fibonacci sweet spot down in here, or at least down to 38.2. So out in this region here, which would be a drop in market price, which would make that put option profitable. Now, because we bought the put option and we didn't buy it, we had to pay $1,285, which means the market's going to have to fall before that purple line at least $1,285. So it's going to have to come down $1,285. Now, it doesn't have to do it all. It's only by the expiration. 1,285. 1,285. That's about as close as I can get it. Right there. So it's going to, that's our little break even line right there. So it's just got to be below there if it hits the purple line. Now, it doesn't mean it can't make money in between here. It's just right there. It has, by the expiration date, it has to be below that line to get to make any money. If it just flushes here and it comes down like, well, you could make a lot of money. That little yellow line is only at expiration. So that brings me back to the question that we had. How much money does the market make in between these two, between the purple line and the little triangle where we got in? So that's the carnival game, right? The carnival game is that the market has to fall to make money. And so 1,285, see, we're down $70 right now. The market just didn't go anywhere because we got time decay. Remember, we got time decay that marches to this, the death march towards expiration. So by the time that gets there, if it just went straight flat across that green line, by the time it got there, we'd lose $1,285. Because we're losing money every single day that we hold on to this thing and the market doesn't fall. So we're down $70. Okay, so let's go look. I'm going to show you a little tool that you might find interesting. I think it's a good tool that you can use to help you learn. So we're going to come over here. It's called Options Profit Calculator. All right, that's the link. Now, I got no association with these guys. It's just a neat little tool that's kind of fun to use. Options Profit Calculator. So we go to Options Profit Calculator. And in here, you come in here and we say, we're going to, let's look at what we're doing here. We're going to buy a put. Okay, so we got a put. And we're buying a 315 put that expires on 116 on Google. So we're going to come in here and we're going to long call a long put. Okay, that means you're bearish, meaning we're long put, meaning that we're buying a put. Okay, so we're going to hit long put. Now we come down here and we put in the information that it's asking for. So what is the symbol? The symbol that we're doing is GOOGL, Google. And the current price of Google is, should load that, 316.38. That's where it's currently at. So we're going to buy an option. We're going to select the option, which one? It gives you a little table over here. Now our option is expiring on 116. So we're going to say December, January. And so we have a January, oh, we need 16 January. Here we go. 16th of January is when our option is, come on, get out of the way. 16th, got so many ads in here. So if you come in here, 16th of January is when ours, see it's right there. 1/16/2026. We picked that up here when we bought it. So now what's the strike price? It's a 315 strike price. So we come down here and we find 315 in the list. There it is right there. And it's a put. So we're just going to do the midpoint. We're just going to grab the midpoint right there, 1225. Now, when we got that in here, how many are we going to do? Well, we're just doing one. So you're going to agree that this is just a calculator. They're not making any promises. And you're going to hit calculate. And what this is going to do is it's going to give you a little table in here. I'm going to blow this up so you can see it. Your profit line. Okay. So this is what this is doing. Now, this is where we bought it. This is the strike price. This is the expiration out here. And you can see at any price in the market, wherever it goes. Remember, I told you it looked kind of like a loan table when you buy a house, an amortization schedule, because it's all over the place. Well, that's what this price is. We don't know where it's going to be, anywhere in here, right? Where's the market going to be between here and here? Well, we don't know. It's going to be anywhere. But if it was here, you'd be making money. If it was up here, you'd be losing money. How much would I be losing? Well, from where you got it, if it went up here, you'd lose $75 on January 9th if it was at 321. If it was down here, you'd be losing $313.50. Okay. It tells you how much you'd be down. You'd be down $520 or $42 off of your previous your option. So this in here, see, you're going to lose 100% of your premium. See that? Anything above right here, see 316, 315, that's our strike price. So if the market doesn't fall and it hits above there, you're going to lose 100%. Now down here, you're not going to lose 100% of everything. You're going to lose, some money against what you bought. It's going to be a loss, but again, you're going to make money, but you're going to make less than you spent. So that's what it's calculating here. Spending, telling you how much you're going to lose. And so down here, this is where you start making money over and above the cost of the premium that you paid. So this is kind of a fun little calculator. All right. Now this is for the put, which means that we make money when the market falls. So the market has to fall. So that's why I say if it comes down here fast, then it comes right down in here in the first few days. See, 4, 6, 8, 10, 12, 14. This is December 14th. If it comes and dumps right down here really fast, you can make money down in here. But what if the market dumps down into the green and then just starts to go sideways? By expiration, you still lose money, even though you were up $329. Right? You're up $329 here because the market just dumped out from under you. But then the market just decided to go sideways all the way over to here. Expiration, you lost $33. So the market has to keep coming down to below your, hold on a second. All right, hopefully that's making sense to you. Let's go back over to the software. And you can see that that's all I've drawn here is see that little line right there? That's the little line I just drew. Because all I did is draw in there the same little thing. I just did it over here on the chart. So you got that same little line. That little line right there is down here. So anywhere in here, anywhere up in here, we just draw a box the way you had it. So anything up in here, you're going to lose money, right? And anything down in here, you're going to lose money all the way down here. But anything below that line, you can make money. Okay. So your little triangle come in here. So anything here to here, anything in here, you're going to make money. This is all green. You're going to make money down in here. But up there, you're going to lose money. And that little triangle is your premium that you have to pay back. All right, let's do another one. This is our put option. We're already in there with that one. Let's go to there's BlackBerry. Let's do BlackBerry. Now, this one, we're going to do a little crazy thing. Let's do something crazy. All right. Let's do what YieldMax does on this one. What does YieldMax do? YieldMax does a synthetic long with a covered call. All right. Now, this is a little bit more complicated. This is a sophisticated strategy. Okay. But the idea here is that we think this market's going to go up. The little blue line coming in, it's going to intercept, right? It's bouncing off the 200 period moving average. The market's been making little snaky moves like this from here to here, back down to here, right? So it's been making these perfect little snaky moves. So we go from here to here, up to here, back down to this little snaky move here. All right. So now we think it's going to do the same thing. We're going to go from here to here, and we're going to anticipate another little snaky thing up. Okay. This is not a trade recommendation. Okay. But what we're going to do is we're going to do a synthetic long. I'm going to come in here. I'm going to delete all these out. And it just happens to be breaking above the 200 period moving average. It looks like it's intercepting with the blue lights. All right. So we're going to do a synthetic long, and we're going to do a covered call on that synthetic long. So this is what YieldMax does. And that's why I'm showing you this strategy. I'm not just pulling it out of my hiney. I want you to know this one because I know a lot of you trade YieldMax funds. You might have Tesla or NVIDIA or Misty, or this is how they do it. Okay, so they're going to come in. They're going to go to their options table, and they're going to say, we're going to go out. And you can do it again, 15 days, or you can do 43 days. Now they used to do a little bit longer time frames because they wouldn't pay their dividends out for a month, but they would do ladders. So ladders mean they do short ones, middle ones, and long ones. So they do all kinds. So they've always got them. They've got options expiring all the time. Okay, that's how they can pay out every week because they got options expiring all the time. Whether they're longer term or shorter term, they're all laddered in and laddered up at different levels. But we're just going to do one. We're not going to do a whole ladder like they do, up and out. Okay, keep it very simple. So we're just going to pick one. So we're going to say, since we want this market, we're going to anticipate, let's say, let's make some Fibonacci projections so we can decide the timeline. So we're going to come in here and we're going to say, well, if the market's been moving through these little wave patterns like this, we're going to anticipate that maybe to get back up to the high up in here, and that's kind of our goal. Let's see what up in here somewhere. If it stays on this same trajectory of what it's been doing, kind of like, just kind of the same trajectory, we would say around January 16th. So mid-January, we should be back up to these highs, testing these highs again. Okay, we made a lower high here and we made a higher high here. So actually, technically speaking, we're in a wedge pattern like this, right? We're in a little wedge pattern. I don't know how far back that goes, but you can see we're probably in some kind of a little wedge pattern. It looks like it's coming out of the bottom of the wedge and go back up. That's just a little pattern because we're not making higher highs and higher lows. We're not making lower highs and lower lows. We're not making a downtrend. We're not in an uptrend. We're just kind of going through this little snaky pattern. Okay, so we're going to anticipate an uptrend on this next little snaky pattern. Doesn't mean it's going to happen. It could come up and it could just easily come down here. It could hit this little blue lights like that, and then it could turn and it could fluff out and die down here. Could do that too. So we could put in a contingency in case that happens. But for us right now, we're just going to keep it simple. All right, we're just going to keep it simple. We're going to come in here and we're going to say, we think it's going to go up. We're going to pick the direction up. Again, we're not doing neutral option strategies right now. We're trying to pick direction. So the direction is up, and we think it's going to come up and it's going to touch this high up in here at probably around January 16th. So if that's the case, we need at least 30 days beyond January 16th. So that would be February 16th. So we have to come out here and look, what do we got out in February? February is 2. We don't have anything in 2. So we're going to have to go out to this one here, 106 days. So we're going to pick that one. Okay. And we're going to come in and we're going to buy a call right here. Very simple. Oh, look, we can do 41 or 61. These are not very expensive. What is it? Oh, it's only a $4 stock. This is okay. Let's see. Problem with this is there's no volume. We like this volume. I have a rule of thumb. Volume at 100, open interest at 1,000. Now, open interest is way over 1,000. But look, we got a $12 spread. So we're going to have to pay $12 in and $12 out. So the spread is 0.22% of our premium. That's not too bad. But there's no volume. We might not get this filled, or we might get filled. We might get in, but we can't get out. Remember, we talked about that. Sometimes when nobody let you in, nobody let you out because there's nobody to trade with. So this is a bad example because we might not be able to get our orders filled. Let's go find another market. This one you might just want to buy some shares. Okay, we'll just come in here and buy 100 shares. All right. All right, so there's that one. But land, what if it goes down? Well, you'll start losing money, but you only have 100 shares. I mean, goodness sakes, it's a $400 investment. You could put some more in here, buy another 100 shares down here. If you're going to do it, I'd do that with an option, land, so I get some premium. Problem is, there's nobody going to trade with you. There's nobody here to do options. You can't do options. Nobody to trade with. There's options long. Open interest is a lot, but there's nobody trading it today. Zero. That's really interesting how we have a lot of open interest, but we have 0 traders. That's odd. That's really odd. Why do we have so much open interest and no traders? That's odd. Okay. Anyway, we're just goofing off, wasting time here. Let's get busy. Let's find another market we can trade. We did Nvidia, Soxy, SPY, Tesla, Ulti, United Health. Wow, there we go. United, well, it's not very good either. Look at the volume on that one. It's really low. It's got good open interest, not great. It's over 1,000. 43 on the volume. That's not good. We'd like to have over 100, but we're going to give it a shot anyway. All right. So this is okay. It's intercepted here. We're going to use our justification. We think the market's going to go up. Okay. It's gone up. It's gone down. We think it's going to go up again. Okay. So that's what we're going to do. Or we could listen to the news. Go listen to the news. Are they going to tell you whether it's going to go up or down? You're going to buy. Go listen to the news. What are they going to tell you? They ain't going to tell you nothing worthwhile. All right. So we're going to decide on United Healthcare. We think this is going to go up. So we're going to come in here. Now, the reason I'm doing this example is because I'm trying to teach you what YieldMax does. They're going to come in here. They think the market's going to go up, so they're going to buy a call. They're going to buy the call basically at the money right here. And it's going to cost them $2,857. Now, where do they get that $2,857 from? Well, if they're going to buy a call, they would go to their cash money to buy that, right? And who's given them the cash to trade with? You did. So you gave them your money to trade options on UNH. Actually, I don't think they trade UNH. But if you give them your money, you put it into their fund, and then they take that fund and the money and they use it to buy their options over here. They use your money to trade with, right? But because they're going to use a margin account, they just use your money to secure their margin positions. So they don't actually take your money out and put it into Tesla. They don't actually take your money and put it into anything because they're just trading options, and options gives them the right, but not the obligation to buy the underlying stock. And they don't ever take possession of the stock. They don't want the stock. All right. They're just trading the premiums. So they're going to buy a call, but you know what? How they're going to pay for it? They're not going to go to you and say, give me $2,800 to buy this option. What they do is they come to the market and they say, I'm going to sell a put at the exact same price. And if they sell a put and they put it right on top of it, just like that, you can come and see that the orders, so they've sold a put at the exact same price as they are buying a call. Now, those should be pretty darn close to each other in price. But what's happening here is they're going to pay $2,800, okay, $2,800 for the call option. Now, if they were to buy the premium, if they were just to go buy the shares, because there's a lot of companies out there, you heard us talk about JEPI and JEPQ, they actually do buy the shares. So they'll buy the shares and then they'll sell covered calls against it, and then they give you those gains. All right. Now, they give you the dividends as the premium that they're collecting from the covered call. They don't give you the profit. That stays in the market. Okay, they buy the shares and then that stays in the market. So it's a little bit different strategy than what YieldMax is doing. So YieldMax doesn't actually buy the shares like something like JEPI or JEPQ might do. So YieldMax comes in here and they say, all right, what we're going to do is we're going to trick the market. Okay, we're going to do this sneaky little trick. We're going to buy a call at the money where they want us to pay $2,855. But instead of paying $2,855, we're going to sell a put at the exact same strike price and collect the premium from the put to pay for the call. Sneaky little buggers. Look at that. We're going to pay $2,845, but we're going to sell a put at the exact same price. We're going to receive $2,332. Now, last night when we did this little example in the class, remember we had a credit spread because the put option was actually higher. We got more money from the put than we had to pay for the call. But in this case, the call is more expensive. That's because people think the market's going to go up. You got a put and a call. One makes money when the market goes down. One makes money when the market goes up. Remember, we were talking about this, where the option prices will change and be different. Well, this is the exact same strike price, one for the market going down, one for the market going up. Well, you have to pay more for the one where the market's going up. Why? Because more people think the market's going to go up. So they're going to charge you more money for it, $2,827. Well, what about the put? Think the market's going to go down. Well, you only have to pay $2,300 for that one. So when you sell the put, you're only going to collect $2,300. So that means that it's going to be in this example, it's going to be a debit spread. All right, a debit spread means you have to pay more than what it's not exactly zero. So you're going to have to pay $528. Okay, you could do this. You could you could push it up one. Boop. Now you push that little put option up above, and now you only have to pay $28. You could do that. Nothing wrong with it. It just you could get assigned if it touches the purple line underneath, right? If it touches the purple line underneath that red line, you get assigned the shares, and they don't want the shares, so they would take a loss if they did that. But you could do that. You could put that up there, and then you end up with a credit spread of $28 rather than a debit spread. If we put it right on top of it, we're going to get a debit spread of $495. But we'd be putting that put option in the money, right? Which would mean we'd get some premium out of it. And then the market would definitely have to rise. We have to be good at picking market direction here. All right. So now we can actually do that. Let's, in fact, just for fun, let's do that. So it makes it exactly the same. We're going to receive $35 rather than pay. By putting that there, we're going to have to pay $495. Well, we don't want to pay anything. So we're going to push that up one tick right there, and we're going to receive $35. So it's almost exactly the same price. Now, that's called a synthetic long. Now you're going to make and lose just as much money on your options as you would on your as if you owned 100 shares. But yet we're getting paid to do it, $35. Isn't that a sneaky little trick? If the market goes up, we're going to make just as much money as we'd make if we had 100 shares. If the market goes down, we're going to lose just as much money as if we had 100 shares. So if you're going to do this, you kind of want to make sure that you have a pretty good idea the market's going to go up, right? Because it's like owning 100 shares, but you're owning 100 shares for free. That's the coolest thing ever. That's the coolest thing ever. Sometimes I have to tell you guys what cool is, because you're like, this is you're being introduced to this. You don't know what cool is. So I have to tell you, this is really cool. This is something really cool. Okay. So now we still got to do what yield max does. Now, what does yield max do? Now, yield max, again, they're sneaky little buggers. So they're going to come in here and they're going to sell a call up here. And what's that going to do? Well, they're going to sell a call right there. And this is going to receive another $1,000. They're going to receive another $1,000 on top of what they're going to make if the market rises. Now, they just capped their growth. And actually, I don't think yield max doesn't do 106 days. I think they, for the most part, they only do right around 30 days is their goal. They like to have 30-day options. Now, they do shorter too. They'll do shorter options. So this 106 days, they're not doing these long ones. This is just for us. All right. And we did that. Oh, we were doing that because of the other previous. That was because of Bed Bath and Beyond, or no, bed, whatever, BB. Blueberry. So we were looking at Blackberry, and that's why we did 106. We don't need to do 106 here. We do our Fibonacci projections. We should probably look and see what we could do, something just to get up to where this is about here. That would be January 13. We could probably do shorter time frame. January 13. We could probably do 78 days, maybe 43 days. We might even be able to do a 43-day one. So we come in here, we just change this over to 43 days on all these, just for fun, just to do it, just to see what it does. Okay, so now we're going to receive $500, but we cut our time in half. So that's good. So now the thing that we got to take into consideration, we're going to receive $367. We're going to pay $1,955, and we're going to receive $1,817. So let's kill this one let's clear that one out, that call. So this is just the synthetic long right here. We're going to receive $138. Let's put that right on top of it. Now we're going to pay $413. Nah, I don't like to pay. I like to receive. Okay, receive $122. All right, so that's a credit spread. Now we're going to make as much money if the market rises as we are if the market falls, and we don't have that break-even thingy that we have to cover. We got no break-even, and it's the same thing as having a call, but it's paid for. All right, but we don't have a break-even that we don't have to match a break-even. So now we're going to put the covered call in here. So now we're going to come in here and we're going to sell a call up here, and we can sell that call up there and collect another $367. Now, The problem with putting the call in there is that if the market takes off and goes to the moon, what if it goes way up here? Well, we sacrifice everything above that red line. We're sacrificing it to get the premium of $367. Because in this case, we don't think it's going to go above the red line. But what if it does? Well, if it does, you could have made an additional $7,000 if it went all the way up to this line here and hit the purple line up there. If it takes off and goes to the moon, just like bam, it goes wham, way up there, you lose a lot of money. Okay. You don't lose it, you just don't make it. So that's what I oftentimes will call the one in the hand or the two in the bush. Would you rather have one in the hand or two in the bush? Well, the two in the bush means that the market's going to go to the moon. Well, how often do you think the market's going to go to the moon when you're trading? Well, I don't know. Might. Yeah, but what's the odds it's just going to take off and go to the moon? I don't know. Probably not very high. Right. It's probably not very high that it's going to take off and go to the moon. Might. So you have to trade off. Are you going to take the $367 today or say, well, what if I want it to go to the moon? Okay, if you think it's going to go to the moon, you should not do this. Don't put this on here because that caps your profit at that level for $367. But if it stays underneath that, if it goes out a little bit more closely to that Fibonacci line, in fact, you could come in here and line it up with that Fibonacci projection line, right? That would be a smart idea. If we say that it's going to intercept right here, why wouldn't we put our option right here? We could put it right up there, right at the interception zone. Now we're only going to make $195, but that would give us more upside potential if the market did follow that line up. We'd make $6,925 on the growth, and we'd also get our $195 here and not cap any profit above there. But what if we don't think the market's going to go that fast? It's not going to go that high, that far. Well, you pull this a little bit closer, and you get a bigger premium, $507, but then you lose everything above it. So that's why when you are trading with yield max, sometimes you get big premiums or sometimes you get big distributions, right? You'll get a big dividend, and then the next month you'll get a small dividend. And sometimes you get almost no dividend. And then it gets a really big dividend, a smaller dividend, and a bigger dividend. It's because this is how they're trading. They're taking your money and using your money to back this trade. And then what happens is you get to participate in the big move. So if they put this way out here, well, they get to make a whole lot more than if they put it right in close in here. Okay. Now they make the 500, they make more here, 500 here, as opposed to only 144 here. But on the upside growth, they make more money. Now they've got this all dialed in with computers, right? So they've done all the probabilities, so they know where to put this out here. So they have mathematical models that will tell them where they should have that covered call to get maximum profit potential on each trade. Now they don't know what the market's going to do either. They're just going off of past performance. Again, past performance not necessarily indicative of future results, but it's best we got. And that's how YieldMax does their fund. That's how they do it. All right. So we'll go right about there, just a little break above, and we can come in here and we can just go mark. We're going to mark it into it. See if it'll let us have it. No, it didn't let us have it. It tossed it out, waited too long. Okay, let's go see. This is, we got what happened there? Oh, we got an open order. Let's just close that for now. It's not confusing what we're doing. Okay, let's go back to our options chain. Let's see if we can get this on. I'd really like to get it on UNH, even here in the demo account. We're going to try and get it on here. Okay, we got to do a little faster because we're waiting too long. So we're going to come in here. We're going to buy a call. We're going to buy a call right there, and we're going to sell a put right there, and we're going to sell a call. I'm going to sell a call right up there, right about there. All right, so now we're going to have to go to they're asking 152. We're going to go down to 80. Oh, we got to go all the way down to 85. I think we got to go all the way down to 85. Look at that thing. The spread on this is going to be really expensive. $67 to put this on. See if they'll let us have it. Did I go the wrong direction? It's not going to be 152. Let's try it. It says the spread is 0 if I do that. That's not right. Oh, it was. That was weird. Okay. Anyway, they put it on for us. There we go. And I think that it said our commission was 0, which was weird. I don't think our commission should be 0. Positions. Chart. Oh, there's total gain. Oh, it did. See it? $33.50 was our loss right now. So that was our spread. That was weird. It showed us 0. But now in here, it shows us $31. That's our $33, and it's actually moving in our favor, making us money. Look at that. We're already up from 33 to 18. We're making money on it. Okay, that's the name of the game. That is that's a synthetic long with a covered call. And that's how YieldMax trades your money for you when you go into a YieldMax fund. All right, guys, I think we've kind of wore out our welcome here today. Covered a lot of ground. Hopefully it helps you understand a little bit of what's going on. And I know it's a little bit complicated in the beginning, and we've been talking about some pretty complicated stuff. So just kind of stick with it and keep learning. And lots of other YouTube channels teach this kind of stuff too in different ways. You can get lots of people helping you understand it, but of course, nobody's going to teach it as good as I am. So come back and meet with me again. Make sure you do it on Friday at the university. We're going to have another class Friday. Today is Thursday. And so we're going to have Friday. We should do a class Friday afternoon at 1 o'clock to do some day trading just for fun. And then we have our final class for options. Maybe we can do some options. Maybe we'll day trade with options. That's a good idea. Tomorrow at 1 o'clock, we're going to day trade with options. How's that sound? So we can combine our options with our day trading class. We'll day trade with options at 1 o'clock in the afternoon tomorrow. And then Friday, that's tomorrow, is Friday. And then Friday night, tomorrow night, we have our final class at the university. And that's the final class for the entire semester. So the semester is over. We're going to start our new semester in January. And we're going to go through these whole things all over again. So if you missed and you weren't able to make the first few classes, and you missed all the stuff on the YieldMax and the Granite Shares funds and how all those funds work, then you can come and take those classes again at the university. And then, of course, we'll cover them here in the labs as well for those of you who can't make it to the university. All right, guys, that was a lot of fun. That was pretty intense. Hopefully you learned something from it, at least if not thinking you're going to do it yourself. Maybe at least you understand what YieldMax is doing with your money when you give it to them to trade. Okay. All right, let's come down here. Paul says, see you Friday. See you Friday, guys. Okay, we got to play a little bit. We got to do one more thing here. Don't forget this. Don't forget.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
You must have something wrong with your brain. Now, everybody wants to know my software? Here it is.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, guys, that's all I got for you today. We'll see you tomorrow afternoon. We'll do some day trading with options, and then Friday night in class.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.